Hey traders, Raghee here. Welcome to Charts and Coffee for Thursday, June 17. Great to see everybody. Happy Thursday. All right, so we've got an interesting session coming up. It's the post-FOMC aftermath session, and it will be very interesting to see what emerges as an intact trend. There are a number of intact trends in this market still. S&P is one of them. The Dow is barely, but kind of hanging on to the 55 EMA. This particular trend on the Dow, notice that we have, let me grab my drawing tools here. Notice that we have actually gotten to the 55 before, found some support here, which is great. And for now, I'm going to presume that's going to be the case because the overall trend has been up, even though from time to time we've gone a little neutral. Again, the trend has overall been up. So I'm not going to bet against what's been the dominant trend here. Just know that the Dow is where the reflation trade hits most directly. And if there's any part of this market overall, there's any segment of this market that was hit very hard, it was actually that reflation trade. Those sectors and commodities that have been in uptrends for weeks, if not months, as we see inflation tick higher. So that's where we are in terms of the psychology of this morning. Another thing to track is what's happening with the US dollar. We'll talk about the dollar and the euro here. And if you take a look at the dollar, now this is the dollar index futures contract, which I'm not a huge fan of using to measure the dollar. I'd rather measure the dollar via its negative or inverse correlation to the euro. But it is worth noting, as you can see here on the chart, we're right at this 200 prop dot, the 200 EMA. And I would expect this area here to be some resistance. So let's see what happens. Now, that should, in many ways, sort of correspond with what's happening on the euro. So ideally, if we're going to see the dollar slow its strength, the euro has to be at or near support. Now, what is troubling in this particular market, the euro, is far larger than the dollar index. And you'll notice we are breaking that 200 EMA right here. So that's a little problematic. We still have a neutral yellow market, as you can see there. But until this euro starts to flatten out, until we can start to see some reason for the euro to catch a bid, maybe an inside day, maybe a minor low, until we can start to see that, it's going to be relatively tricky. We've got the beginning of what could be our minor low pattern, as you can see right here with the alert. But let's keep in mind, we really need to see, ideally, what would I do with a situation like this? What I'd really like to see for the next candle, not this candle, is maybe a minor low or an inside day in the lower half of the candle. So there's a lot we still have to determine about what this market is actually capable of, and I think we still need to be patient. But I do like some of the pullbacks. The S&P is one of them. Really tough for me not to continue to be quite optimistic in two of the places that I've been probably most optimistic, energies and financials. Now, these are longer term conversations, right? The other thing that we can do, of course, is shorten the time frame. And shortening the time frame gives us a really great, and I love this, it gives us a, well, I don't care, right? When you're short-term trading, what's going to happen tomorrow? Is the trend going to continue? Is the trend going to reverse? You get that wonderful, I don't care, right? And that's where the short-term time frame does free you up not to require overall clarity, continued directional bias, etc. Which, right now, with the way in which the market's trying to determine what the Fed wants to do next. Very mixed picture. I thought it was actually quite unusual that Staples took it on the chin on a day that we might consider defensive, somewhere the market would flock to. Dollar moved higher. That's quite defensive. But, we saw also gold get rocked, as you can see right there. So very mixed picture in terms of how this market is reorganizing and responding to. I thought Jerome Powell was pretty clear, but the market is reading between the lines and looking ahead and thinking, well, the punch bowl is really where we got to start thinking about what it would mean. And we are talking about 2023. We are talking about 2024. That's how ridiculously far ahead this market's starting to panic. But here we are, right? I don't know why people look for the market to respond anything other than like a 3-year-old. Logic is not what rules the market. It's a lot of emotion. So let's see how the emotional dust settles. So let's talk about gold. I have a long position in gold. I was looking for some weakness, and that's what we were looking to buy into. But I did not, and quite frankly, I don't know a lot of traders were expecting gold to break some key levels. I will watch gold very carefully where it is right now, because you can see here that we are sandwiched between two pretty interesting zones. We've got the 55 right here, 55 exponential, and we've got the 200 right here. So we got the 55 and the 200 exponential in this window. And if we are going to find some support, this would probably be as good a place as any to see it. I would like to see clearly some support kick in. And then so to your point, if you're down 25% on premium paid, and these are not expensive options, but here's the thing, there's no harm in taking the medicine and cutting this loose, and then maybe looking for a minor low or an inside day tomorrow where, in fact, we can then re-engage the market in this particular zone, with that 200 probably being the more important of the two levels, clearly, that we need to hold at this point. So I don't mind taking a paper cut. I think that's something we talk about a lot in the Sector Secrets room, which is take the paper cut, take the small loss, because there is this mental line in the sand that we all have and have to battle against, which is, and some of you might have probably experienced this before, that psychology of, I can't get out now, I'm losing too much, right? What is that amount? So one of the things that I've done, and it's really more of it's probably equally a mental trick, if not slightly more of a mental trick than it is simply the arithmetic of not blowing up an account. And that is making sure that when we can take losses, they're small, even if they're frequent, they're small. And if they're small, planned out, predetermined paper cuts, yeah, they sting. I mean, losses are supposed to a little bit, but I'm not going to lose a finger, right? Paper cuts, fine. Don't want to lose a finger. And I think a lot of traders, it's any wonder that they can actually type it all with all the major losses and fingers, right? So that's kind of the mentality. Don't get close to whatever that chasm is where you cross over from, I can't, this is a small paper cut, to I can't get out now, I'm losing too much. Remember, that's a mental chasm. Yes, there's some arithmetic to it, but keep that in mind. Yeah, if you can sit through this and you're not exceeding the account limitation, JMO, I actually don't have a problem with that. So either way, I think you're fine. And as if this week isn't, raucous enough, we've got then tomorrow's triple witching, which might seem sedate in comparison to what we just dealt with and are dealing with the Federal Reserve. So thoughts on GLD and SLV? I'm actually bullish both of these. But remember, SLV is going to be caught in that tug of war between what's happening in copper and what's happening in gold. And if both of those are heading lower, SLV's got no choice but to head lower. But remember, copper is a play on economic optimism and equity strength, while gold is a play on a real yield narrative. So for gold to move back higher and possibly take silver with it, the real yields have to drop. Okay. And right now that's a challenge, because if the Federal Reserve is readying the marketplace for a potential 2023 rate hike, that means that rates are higher if inflation is still moving sort of flat, according to the FOMC, or ticking higher, depending on the way that calculation is of the nominal yield of a bond minus the rate of inflation. We might be seeing a slight tick higher in the real yields. Now, here's where I said, if anyone's looking for some really good synergy in this market right now, I think this market doesn't know whether to scratch its watch, or, it's a saying Dolly Parton says, I don't know whether to, how does it go? Scratch my watch or itch my, well, I'll have to work on that one. It totally escaped me, but she's got a great saying from Steel Magnolias in the best Dolly Parton way of confusion. This market is super confused, right? So if I don't know, that's what it was. I don't know whether wind my butt or scratch my watch. Okay, so that's what it was. I love that. I love Dolly. So that if you're looking for some organization right now, we don't have it. We don't have it. If we're thinking that yields are going to be going higher, I mean, that's why the panic is, right? Taper comes first. Asset purchases are going to be slowed. Then, that's the taper, and then higher yields are to come. Why on earth would we be seeing the 30-year bond ticking higher? And remember, the Federal Reserve did not change the asset purchases. So very unusual action. And yes, we're in that seasonally weak time of the year. But look, just to sort of hang our hat on seasonal and say, well, we're supposed to be weak right now, as if the market is sort of on some sort of schedule that sharply, as if the market was that easy to time. I am still actually quite bullish, but I'm only bullish in the places that are either barely yellow in terms of our JT multi-trend measurement, or still nice and double green. And there are corners of this market that are still extremely resilient. Financials are one of them. Energies are definitely one of them. I actually like healthcare quite a bit. Industrials, they're hanging on. It doesn't look great. They're hanging on. What else do we like? Gosh, communications have been really, really strong. So there are corners of this market where, even though we had the Fed and that psychology that swept through the market after 2 p.m. hit very hard, there are corners of this market are doing really well. So find the double green, or shorten the time frame. So you can take that I don't care wonderful attitude of that short-term time frame trading, day trading, or you can go do the homework, find the names that are still resilient, make that the bulk of your watch list. I hope that helps. All right. So I don't think the market knows what to make yet of what, again, broadly, indices, metals, treasuries, currencies. I do not think this market really clearly is messaging sort of a unified idea. And I'm not seeing that yet. The harmony of what risk aversion should look like, the harmony of what fear of higher rates should look like. I don't think we're there yet at all. So let's give it another session, but again, am I bullish metals? Yeah, actually, funny enough, I am. I think copper got hit hard, but I'm still bullish copper. I think silver and gold got hit pretty hard, but I actually am. But being bullish and having a buy setup, gang, those are two different things. So please keep that in mind. Being bullish and having an honest to goodness buy setup, they don't always correspond, so we have to be patient. So would I consider any bearish bets? So this goes back to structure. This goes back to, where do I have really clear bearish structure? Not that we had a down day, not that there was bearish momentum, but where is the bearish trend? Where are those markets that over the course of the last few weeks or days have gone double red, or have shown that there is a short setup? And I don't have broadly, if I take a look at a particular sector or index, I don't have that set up really clearly. I think that we could be sitting at some resistance. We've been talking about this quite a bit in charts and coffee. We know that this area here went up a little bit higher, as you can see. You can see this little, it went up a little bit higher. through what was this Darvis here, this older Darvis. But one of the things I mentioned is NASDAQ is actually still in yellow, as you can see at the very bottom of the screen, the JT Multi. The NASDAQ is still in a yellow distribution sideways market where I am expecting chop, not breakouts. Breakouts are more when we have a narrower consolidation, right? And that's when we'll see that breakout to the up or downside. But when the range is quite wide, as this one is, it's really more about this being resistance and this area down here being support. So this doesn't surprise me that we're pulling back a little bit. So if you are thinking about, well, where is there bearishness? There's not a lot of bearishness. And then secondarily, you can ask yourself, well, where is there resistance that the market could be moving lower on? I think there's quite a few distribution markets out there, mostly in tech. I'm not bullish tech, but I'm not bearish tech either. We're in chop. So depending on, whether we're close to a support level or a resistance level, one thing I will mention for those of you saying, okay, Rag, what about day trading wise? And what about directional bias? We talked about that quite a bit in yesterday's webinar. If you guys check that out already, you can check out the class that's coming up next Saturday at simplertrading.com/climb. It's the day trading playbook that's coming up. And if you recall from the webinar, and you can catch it on replay too, we have our 2 anchored VWAPs. And as long as we're in this area here, I will have bullish directional bias going into this session in the NASDAQ and in the S&P. What about the Dow? I do not. I can't have bullish directional bias intraday in the Dow, and I don't in the Russell. So these are things, this is just one of 6 things that I'll look for on the daily as a precursor to the day trading that I'll be doing here in about 2 minutes, all right, in the futures room. Okay, so yeah, a lot of confusion. So if you're feeling confused, it's perfectly normal right now. I don't believe we have a clear idea of what this market broadly, index, sector, stocks, commodities, currencies, treasuries. I don't think we have a clear picture of what we need to take away from yesterday's meeting. All right, so let's see. Hey there, John. Great webinar last night. Oh, thank you very much, John. Yeah, we had a really good conversation, about 75 minutes, and I hope that the tactics that we outlined from the the best time to trade, to pick a side, to look at the clearing range. I hope those are things that you guys can put to work, today. That's always what I like to do, these webinars where, yeah, of course, we've got a class coming up and we're going to be doing a far deeper dive. But I love for you guys to have some actionable things to come out of that webinar and then put to work the very next session. So I appreciate that. How can I make a scan watch list show which stocks and futures are breaching their initial balance? John, I don't think you need to scan because I'm not looking at 20 things at once. What we're going to be doing is, as I mentioned in the webinar, start at the index level, look for clarity there, then go down to the sector level, then go down to the stock level. So it really is a filtering process. Now, as far as breaches go, I can't imagine it would be difficult to have some sort of breach scan. Lorna, if you're listening, I don't know. Can we have something like that? Let's see. I'm not really sure. It's not something that's necessary in my approach, but I would say you really want to start with the indices first and maybe a handful of the heavily weighted sectors. And then at that point, when you see the clarity, the way that you're moving will be far more logical in the progression of what will be demanding your attention. So it's more of a sorting thing that I'll look at through those first 30 minutes of the morning. All right. And just like that, it is time to wrap up charts and coffee. I'm looking forward to seeing you all tomorrow. Really looking forward to seeing you all next Saturday for the class. And in the meanwhile, be most excellent to each other, and I will see you tomorrow.